The main difference between VTI and VOO lies in the indices they track. VOO matches the performance of the S&P 500 index, which tracks the performance of the top 500 largest companies in the U.S., making it ideal for investors seeking exposure to famous U.S.-based companies. In contrast, VTI tracks the CRSP US Total Market Index, which makes it ideal for investors who want to diversify into smaller companies. This broad-based approach to investments means that VTI encapsulates VOO, offering more diversification. VTI's focus on the CRSP Total Market Index results in a fund that includes small, mid, and large cap stocks, making it more volatile than VOO, which focuses on the S&P 500 index and is dominated by large cap stocks. This higher volatility creates higher risk and higher potential returns, making VTI less ideal for risk-averse or new investors. On the other hand, VOO is less volatile, making it attractive to new investors. Historically, VTI has outperformed VOO over the long term due to its inclusion of small and mid-cap stocks, which tend to be more volatile but also offer higher potential returns. Despite their differences, VTI and VOO share some similarities, including being managed by Vanguard, having a similar total expense ratio of 0.03%, and being distributing ETFs that pay dividend payments every quarter. Ultimately, the choice between VTI and VOO depends on the investor's strategy and risk tolerance. A combination of both may be the most effective way to invest, as it allows for diversification and potentially higher returns. However, for experienced and adventurous investors, VTI may be the better choice due to its higher potential earnings and broader diversification.